I have looked at 100 real portfolios in the last 2 years, and the number that shows up in almost every single one of the ones that failed is $147,000. Not 150, not 200,000, 147. That is the average balance at which people bailed. They saw that number, decided the math wasn't working, and made a change that cost them more than most Americans earn in 5 years. And I can prove it. Before I get into the actual data, I want to tell you something I almost never say out loud in these videos. Most of the people I reviewed were not making bad decisions in a vacuum. They were making completely logical decisions based on completely wrong information. The financial media handed them the wrong diagnostic tool and told them it was a stethoscope. They listened to their heart and heard something they didn't recognize. They concluded something was wrong with them. Nothing was wrong with them. Everything was wrong with the framework they were given. That is what this video is about. Not motivation, not willpower, not another chart that curves beautifully upward into some distant future version of yourself. This is about one specific number, one specific misdiagnosis, and one reframe that changes how you read every single portfolio statement you will ever look at for the rest of your life. I want you to think about a long-haul truck crossing the country. You leave New York. You're heading to Los Angeles. The first 12 hours, you are burning through fuel. Your engine is working at maximum output. Every mile is hard-earned. You're carrying the full load. There is no tailwind. There is no altitude assist. It is pure combustion, mile by mile, dollar by dollar, your engine doing all the work. And then somewhere around the Texas Panhandle, something shifts. You hit a stretch of road that drops in elevation, the wind changes direction, and for the first time in 12 hours, your fuel gauge is barely moving. You are covering the same distance. The miles are going by at the same speed, but the engine is doing meaningfully less work. The road is doing some of it for you. The physics changed. That is what happens to a portfolio at a specific threshold. And the threshold is not arbitrary. It is calculable. It is predictable. And it has a specific dollar amount attached to it that almost nobody in financial media has ever told you plainly, because there is no product attached to knowing it. I'm going to give you that number. But first, I need to show you why the number almost everyone is using instead is wrong, and why using the wrong number has quietly destroyed more retirement wealth in America than market crashes, bad funds, and fraud combined. Here is what most people are measuring when they look at their portfolio. Return rate. They look at their statement, see that their fund returned 8% last year, and compare that to a different fund that returned 9.3%. They spend the weekend reading about that other fund. They consider switching. They wonder if their advisor is underperforming. They think the problem is the percentage. I'm going to show you, with numbers so specific they are impossible to argue with, that for most people in the first 15 years of their investing life, the return rate is almost entirely irrelevant. Not slightly less important. Almost entirely irrelevant. Here is the math. 2 investors. Same age, same starting balance, same time horizon. The only variable is the return rate. Investor A puts in $300 a month for 20 years at 7% annual return. Final balance, $156,200. Investor B finds a fund that returns 9% annually and puts in the same $300 a month for the same 20 years. Final balance, $200,160. That difference sounds significant. $44,000. But here's what Investor B had to do to earn 9% consistently over 20 years. According to S&P's Spiva scorecard, which has been published every 6 months since 2002, over 87% of actively managed funds underperform the S&P 500 over a 20-year period, meaning the fund returning 9% is more likely to be statistical noise than skill. And the investor chasing it is more likely to panic sell during the bad years that come with the volatility required to produce that higher number. Dalbar's annual quantitative analysis of investor behavior, which has been tracking this since 1994, shows that the average equity fund investor earned 6.3% annually over the 20-year period ending in 2023, even while the S&P 500 returned 9.9% over the same window. The behavioral tax from chasing performance wiped out the entire theoretical return advantage. Now watch what happens when we change the variable that actually matters. Investor A. $300 a month, 7%, 20 years. $156,200. Investor C. $500 a month, same 7%, same 20 years. $260,400. No fund switch, no advisor change, no risk increase. Just $200 more a month into the exact same boring index fund. The result is $104,000 more than Investor A. With less volatility, less behavioral risk, and no dinner party stock tips required. The contribution level is the variable that moves the outcome in phase 1. The return rate is the variable that financial media sells you because there is an entire industry built around it. Hit subscribe if you're getting value from this. Without that signal, the algorithm may genuinely never put these videos in front of you again, and I publish this kind of analysis every single week. Now, I want to introduce someone who is going to stay with us through the rest of this video because the abstract becomes real when it has a face attached to it. Her name is Sandra. She is 51 years old. She lives outside Columbus, Ohio. She is a licensed practical nurse earning $63,000 a year. She has been contributing to her hospital's 401k plan since 2009. She has never missed a contribution, never panic sold. Checks her balance quarterly, reads the annual fund reports her plan sends, and does roughly what her HR rep told her to do when she enrolled. Her current balance is $144,000. She is frustrated in a way she cannot fully articulate. 15 years of discipline, and the number on the screen does not feel like 15 years of work. Sandra is not behind because she made bad decisions. Sandra is behind because nobody ever told her about the threshold, and nobody told her that the feeling she has right now, the dull, nagging sense that the math is not working, is not a signal that something is broken. It is a signal that something is about to change. We will come back to Sandra. Her story ends differently than it started. Here is the number nobody put on your statement. The threshold is not $100,000. That is the number financial media repeats because it is round and it fits on a thumbnail. The real threshold, the one that shows up consistently across the portfolios I have reviewed, the one that matches what Vanguard's own long-term compounding data produces when you run it at realistic contribution levels and a conservative 7% return, is somewhere between $115,000 and $135,000 in total invested assets. That is when the math flips. That is the Texas Panhandle. That is when the portfolio stops being something you are pushing and starts being something that pulls you forward. Let me show you exactly what that flip looks like with numbers, because vague is useless and I promised you specificity. At $50,000 invested, 7% annual return generates $3,500 per year in returns. That is $291 a month from doing absolutely nothing. If you are contributing $400 a month, your contributions are still doing 78% of the work. You are still the engine. The road is barely helping. At $100,000 invested, 7% generates $7,000 a year, $583 a month from the portfolio itself. If you are still contributing $400 a month, your contributions and your returns are now roughly equal. You are at the crossover point. The road is starting to do half the work. At $150,000 invested, 7% generates $10,500 a year, $875 a month. Your $400 contribution is now the minority partner. The portfolio is generating more than twice what you are putting in. The road is doing more work than you are. The truck found its downhill stretch. At $250,000 invested, 7% generates $17,500 a year. $1,458 a month in passive return. Your $400 contribution is noise. The second engine is running the operation. This is not a metaphor. These are arithmetic outputs at a conservative rate that Vanguard's own historical data supports for a diversified index fund over any 30-year window going back to 1926, as documented in their annual market review series. The shift is real. It is calculable. And the reason it feels invisible is that nobody ever told you what to look for. Here is the anti-diagnosis. And this is the part of the video I want you to pay the most attention to, because this is where the expensive mistake gets made, and it almost always gets made by people who are doing everything right. You think the problem with your portfolio is that it is not growing fast enough. The actual problem is that you are measuring the wrong thing at the wrong time with the wrong instrument. Here is how I know. I looked at 100 portfolios. The ones that failed, meaning the investor either cashed out, switched to a riskier strategy, or stopped contributing consistently, showed one consistent pattern. The decision to change happened when the contribution to return ratio was still above 60%, meaning the investor was still in the phase where contributions do most of the work, looked at the return line on their statement, decided the number was too small, and concluded the strategy was broken. They were not measuring whether the strategy was working. They were measuring whether the strategy felt like it was working. Those are two completely different things, and confusing them is the most expensive mistake in personal finance. Fidelity published data from their own account holders in 2023 showing that investors who made zero changes to their portfolio allocation over a 10-year period outperformed investors who made 4 or more changes by an average of 1.5% annually. That gap sounds small until you run it over 20 years on a $150,000 portfolio. 1.5% annually over 20 years on $150,000 is the difference between approximately $611,000 and approximately $510,000. $100,000 lost to the act of making decisions that felt rational and were statistically destructive. The financial media does not tell you this because there is no product attached to doing nothing. A brokerage account you contribute to and never touch generates almost no trading revenue, no advisory fees, no fund switching commissions. The entire architecture of how financial information reaches you is built around the premise that action is valuable and inaction is negligence. That premise is backwards during phase 1. Doing nothing is the optimal strategy. It just does not look like a strategy. It looks like waiting, and waiting feels like failing. Now I want to show you what the wrong diagnosis costs in real dollars, because the abstract version of this is easy to ignore, and the specific version is not. Sandra, 51, Columbus, $63,000 a year, $144,000 in her 401k. When Sandra looked at her statement in 2022, her balance had dropped from $128,000 to $111,000 in a single quarter. The S&P 500 fell 19% that year. She did not sell. But she did something that felt more reasonable than selling. She moved 40% of her allocation from a total market index fund with an expense ratio of 0.03% into a managed income fund her plan offered that promised lower volatility. The fund's expense ratio was 1.12%. She did not think of it as a strategy switch. She thought of it as a defensive adjustment. A temporary measure until the market stabilized. Reasonable. Logical. Exactly what the behavioral finance literature predicts will happen when an investor hits a loss at a critical threshold and has never been told what the threshold means. Here is what that single allocation change cost her, not theoretically, in actual arithmetic. $144,000. 14 years until retirement at 65. 40% in a fund earning 7% minus 1.12 in fees, so 5.88% net. 60% in a total index fund at 7% net, essentially. Blended net return, approximately 6.3%. Same $144,000, same 14 years. Same contributions of $450 a month. Total index fund only at 7%. Final balance, approximately $712,000. With the allocation shift, approximately $641,000. The cost of one defensive adjustment made at peak fear is $71,000. Not because the market was wrong, because the fee drag compounded over 14 years on a balance that was about to enter its most productive phase. Sandra moved 40% of her portfolio out of the highest return years it was ever going to have, and she did it at exactly the moment when her portfolio was closest to the threshold where compounding was about to do the heavy lifting for her. She fired the engine right before the downhill stretch started. This is the pattern I see in the portfolios that fall short. Not catastrophic decisions, not fraud, not market timing disasters. A single allocation shift made for completely rational reasons at exactly the wrong moment, compounded by fees that are invisible on a monthly basis and catastrophic over a decade. The managed income fund did not feel like a mistake. It felt like a responsible adult making a measured decision. The financial system is designed to make it feel that way. That is what makes it expensive. There is a research paper from Shlomo Benartzi and Richard Thaler, published in the Quarterly Journal of Economics in 1995, called Myopic Loss Aversion and the Equity Premium Puzzle. What they found is that investors who check their portfolios more frequently make worse long-term decisions because losses loom psychologically larger than equivalent gains. An investor who checks monthly experiences approximately twice as many perceived losses as one who checks annually, even when both portfolios perform identically. The more frequently you look, the more likely you are to make a change that costs you. Not because you are irrational, because you are human and your brain is running software that was not designed for compound interest. The financial industry gave you a quarterly statement. They did not tell you that reading it too closely is statistically likely to cost you more than it saves you. That information is not profitable to share. So here is what you actually do with this. 3 actions. Not a lifestyle overhaul, not a budget rewrite. 3 specific decisions that take a combined total of about 90 minutes and produce results that compound for decades. The first action is to find your threshold date, not your retirement date. Your threshold date. Pull up any compound interest calculator online right now. Enter your current balance. Enter your monthly contribution. Set the return rate to 7%, which is a conservative real-world average for a diversified index fund over long periods, as supported by Vanguard's own published research going back to 1926. Find the year your balance crosses $120,000. Write that year down. That is your threshold date. That is the year the road starts doing more work than you are. That is the Texas Panhandle. Every financial decision you make between now and that date should be evaluated against one question only. Does this get me to that date faster, or does it slow me down? Not does this feel like progress. Not does this feel safer. Does this get the balance to $120,000 sooner? Now run the same calculation with your monthly contribution increased by $150. See how many months earlier you hit the threshold. For most people at median contribution levels, $150 extra per month moves the threshold date forward by 14 to 22 months. 2 extra years of Phase 2 compounding, the years where the portfolio does most of its own work, is worth more in terminal balance than almost any fund switch or return rate optimization you could realistically execute. That is arithmetic, not motivation. The second action is to audit your expense ratio today, not this weekend. Today. Log into your 401k or brokerage account. Find the fund details section. Look for the column that says expense ratio. If any fund you hold has an expense ratio above 0.5%, check whether a comparable index fund exists inside the same plan. In most employer-sponsored plans, it does. According to the Investment Company Institute's 2024 Fact Book, the asset-weighted average expense ratio for index equity mutual funds is 0.05%. The average for actively managed equity funds is 0.66%. That gap is 0.61% annually. On a $150,000 portfolio held for 14 years at 7% gross return, that 0.61% drag costs approximately $82,000 in lost compounding. $82,000, not paid to a market crash, not lost to bad luck. Transferred silently, automatically, quarterly, to a fund manager who, according to S&P's SPIVA data, has an 87% historical probability of underperforming the index you could have owned for almost nothing. The switch takes about 12 minutes. The 12-minute decision is worth more per hour than any overtime, side hustle, or bonus you are likely to generate this year. The third action is to pre-decide your next income event. When is your next raise, tax refund, bonus, or loan payoff arriving? Write the approximate date. Write the expected amount. Write the exact percentage you will redirect to your investment account the moment it lands. Make that decision right now in writing before the money exists. The decision made today in the abstract, while there is no cash in your hand and no competing use for it, is the one that actually executes correctly. The decision made in the moment while holding new money is the one that becomes a slightly nicer version of something you already owned. According to research from the Consumer Financial Protection Bureau, Americans who pre-commit investment decisions in writing redirect approximately 3 times more new income to savings than those who decide at the moment of receipt. The architecture of the decision matters more than the intention behind it. Your future self holding a tax refund check standing next to a home renovation idea will not make the same call your current self makes right now. So make the call right now. Here is what I want you to sit with before you close this video. The most powerful compounding dollars in your entire portfolio are not the ones you invest at 60. They are not the ones you invest at 55 when you finally feel financially settled and ready to get serious. They are the ones you are investing right now, today, in whatever phase you are currently in. A dollar invested today at 7% annual return over 25 years becomes $5.43. That same dollar invested 5 years from now compounds for 20 years and becomes $3.87. You do not lose $1.56 by waiting 5 years. You lose it on every single dollar you invest late. Every contribution you delay, every raise your lifestyle absorbed before you redirected it, every month you stayed in the higher fee fund because switching felt complicated. That is not an abstraction. That is a calculable number specific to your balance, your contribution level, and your threshold date. Now let me close Sandra's story because I said I would and I meant it. Sandra did not make a dramatic reversal. She did not find a new advisor, a better fund, or a secret strategy. She did 3 things. She calculated her threshold date. At her current balance of $144,000 and her contribution of $450 a month, she was approximately 31 months away from crossing $120,000 in investable assets, net of the managed fund drag. She moved her allocation back to the total market index fund. 31 months became 19. The threshold moved forward by a year because the fee drag stopped bleeding the compounding before it could build. Then she pre-decided that when her car loan ended in 8 months, she would redirect $250 of that freed monthly payment into her 401k the day the final check cleared. Not when she got around to it, that specific day. She set a calendar reminder for it right then. Sandra is not going to retire rich in the way that word gets thrown around in financial media. She is going to retire with enough, on her own timeline, without winning a stock pick or finding a fund manager who beats the market. She crossed the threshold at 53. She has 12 years of Phase 2 compounding before she turns 65. Her current projection, assuming she changes nothing else, puts her retirement balance at approximately $680,000 on a $63,000 income. Without extraordinary discipline, without dramatic sacrifice, without a single investment decision that required her to be smarter than the market. She just needed to know what the threshold was, stop measuring the wrong thing, and let the road do its job once the elevation finally changed. 100 portfolios, one pattern. The ones that made it were not smarter or luckier. They were the ones who stayed in the truck long enough to find the downhill stretch. The ones that fell short almost always bailed at $147,000 right before the road started helping. The truck is still moving. The only question is whether you are still in it. If this video changed how you read your portfolio statement, subscribe to the channel. It is the only way the algorithm knows to keep showing you this kind of content, and I put out a new analysis every single week. The button takes 3 seconds and it costs you nothing.